Hello and welcome to the Friday series at 5. I am Neha Pan and joining us today is Mr. Sachin Jain, Assistant Vice President, Research at ICICI Securities, who will be sharing insights on investment solution for current markets. The purpose of today's interaction is our endeavor, which is to enable you all to understand your investment better in the current market condition. Our investors have various questions in their mind before investments, like is this the right time to invest lump sum amount in equity mutual funds? Buy on dips is the basic equity allocation strategy, but how much market fall is the right level of dip to buy? Where to invest in current change market dynamics? Which monthly mutual fund basket is best suited in the current market environment? So, without any further ado, let's welcome our expert, Mr. Sachin Jain. Over to you, sir.
Thank you, Neha, and welcome to all our viewers. The way we are keeping it, this is I'll just try to present 6 to 7 slides, and I'll just maybe take around 10 to 15 minutes and just try to focus on few very important basic things which investors should always focus on and do not get swayed away by the daily volatility. So another 10 minutes. So just bear with me for 10 minutes, and I'll make sure that we'll just stick to the point and will not make it boring. So let's start with a very basic slide. We all know that the upward trajectory of Sensex is very simple, is very predictable, right? The Sensex generally slope upward from 1980s to 2000 to 2010s. It's a very straightforward line. So if we just zoom out, you can just see that it is very predictable. And in fact, by looking at it, you can easily predict the movement of Sensex for the next 5 years, 10 years. So we have to go to basics, especially in an environment where markets are falling, global markets are falling, Indian markets are falling. So we have to revisit that basic chart and basic theory of equity investing, which is wealth is created by following a larger trend. So we need to visit this, that Sensex is a very easy upward sloping slide, which is very much predictable. So we are not here to lose sight on this. Let me take you through a zoom in picture, because if we just try to zoom in a bit, we come across various market falls and various market reasons for fall. So if you look at it, we have come across various reasons in the market in last 10, 15 years, be it the subprime crisis, be it the downgrade in the US ratings when the markets had fallen, be it the change in the government, be it the slowdown in China, devaluation of the currencies, be it demonetization, be it introduction of GST, or be it the US-China trade war. Basically, the point being that there will be enough reasons for market to fall intermittently. And every now and then, after the market has fallen, market has bounced back. So now the biggest risk in today's market is not being there in the market. So what if you exit and market reverts back? Let's assume that if you invest today and market falls further, then ultimately, I know that in the previous slide that wealth is created by following a larger trend. So at least I am in a larger trend. So even if I am investing today, I will be in that larger trend. So I am not missing out on a larger trend. But the biggest risk is not being in there in the markets. So instead of being out of the market, the risk lies in not being in the market. So investors need to be aware of it. It's a very basic thing, but it's just better that we revisit this very basic thing, that risk of not being in the market is far, far higher than being in the market. And just remember what Peter Lynch, the famous investor guru, has said, that more money has been lost in trying to anticipate the market correction and protect from the correction than actually be in them. So remember those words, because at least if Peter Lynch has said something, we need to give a thought on those lines. So another very, very important question which we come across on a daily basis: is it the right time to invest? Now, if you just look at this chart, I have just tried to present the chart. Okay, maybe it will take us time, sometimes with a lag. So let's just bear with me. Okay, so what this chart shows, that equity markets, the Nifty 50 index, generally falls in the range of 10 to 20% every year on multiple times. We have seen Nifty index correcting 10%, 15%, 20% almost every year and on multiple occasions. Even in the current year, we have seen 50% drawdown currently. So even as on today, as we are speaking, Nifty 50 is down more than 15% if we are as we are speaking. Last year, Nifty was down 10% from the recent highs. 2020 was obviously an abnormal year of the COVID year. Even if we exclude those years, in the previous year, 2019, 2018, 2016, 15, we were down 11%, 15%, 13%, 12%. These are kind of a range where the Nifty 50 index has fallen from its recent highs. So the point being that Nifty will fall 20%, 15%, 25%. But what to do? Is it the right time to invest at 15%? So what we are saying is that currently Nifty 50 index is already down by 15%. Invest at current levels as downside looks limited. So market may fall by another 5%, 10%. We don't know. And in fact, nobody knows. So whoever is telling you that the market has bottomed out or market will fall further is telling lies. So nobody knows, and even we don't know. However, what we can say is that the margin of safety while investing at current level, while investing at 15% down from the Nifty level, it makes you more comfortable in investing. So, from a trade-off perspective, if downside looks limited, even if it takes time, I am more for it. So at 15% down at current level, it is the right time to invest. So now, after having, understood that, some amount should be put into equity markets and it may be a right time to invest, at least put some amount. Now the next question comes to is where to invest. And actually, even more important than where to invest, where not to invest. So this slide, if you just look at it, it's a very basic slide. So what it says that the best performing funds are not an ideal allocation of investing in them. So generally, every investor, what they invest in a best performing fund, the fund which has performed best in last 1 year, in last 2 year, in last year, they invest in them. And then what happens? More often than not, those funds after investing, they underperforms. So just look at this example of large cap category. So a particular fund, so these names are only for illustrative purposes and should not be construed as any recommendation whatsoever. So if you look at the large cap category, the bottom, the top table, the fund which was ranked 1 in the calendar year 2021 was ranked 25, was ranked 12, and was ranked even lower in the previous years. So had you exited those funds and invested in a best performing fund of the 2020, you would not have been in the top 10 funds itself. So the point being that investing in a last 1 year best performing fund, last 2 year best performing fund is a very futile exercise. In fact, is the best performing funds historically are a very, very weak indicator of investing into future. So we are not saying that don't invest in best performing fund. What we are trying to say is that a best performing fund needs to be evaluated more, needs to be evaluated on its merit, on its future potential, and not just that it has performed well in last 1 year, so we should invest. So keep in mind, best performing funds are not always the best ideas to invest for future. So now after having understood, where not to invest, or especially at least, evaluate further while chasing the best performing funds, let's look at where to invest now. So now, in general, when we look at it, where to invest, generally people ask, I am a conservative investor, what should be the ideal core equity allocation? It's okay, large cap fund, mid cap fund, sector fund, IT fund, banking fund, it's all okay. But what about the core holding, 70%, 80%, 60%? What should be my core allocation? So what we are saying in this slide is, if you look at, we have just tried to break the previous last 10, 15, 20 years into up market cycle and bottom market cycle. So if you look at it from 2003 to 2008, 2009 to 10, 2013 to 2017, all up market cycle basically. And similarly, we have taken the bear market cycles. So if you look at it, the flexi cap funds or the multi cap funds are generally a stable performing funds. Generally, they don't rise too much, but they also don't fall too much. So ideally, the flexi cap funds or the multi cap funds are the most appropriate funds for all type of investors. So these category of funds should form the core allocation holding for any investor. Now, after having understood, the basics of, about where, I mean, the flexi cap funds, we understood, okay, are the core holdings. But what about the market behavior? What about the active investors, which are generally more savvy, which generally will try to generate alpha in terms of market segment where they should invest? So, all active investors must understand that market in general performs in cycles. Understanding the market cycle is as important as while invest whether to decide whether to invest or not. So, and investing at a later part of a market cycle will give you a more better experience, because you're entering at the market cycle which is already near its peak. So generally market performs in like a typical cycle. It goes up, it goes down, it goes up, it goes down, similarly to the large caps, similarly to the mid caps and the small caps. So for instance, while deciding between the large cap funds and say mid cap and small cap funds, most investors invest in say mid cap funds or large cap funds when they've already outperformed. And when the overall market cycle turns, the category which had outperformed earlier starts underperforming. And that's where the investor experience starts getting not so very well as it's ideally supposed to be. So it is also important to never forget the big picture or the extent of outperformance or underperformance in the current market cycle. For instance, if the overall market cycle, if the current market cycle were to continue, and the markets from now on is likely to trade with a negative bias, or markets is likely to fall further, small cap funds and mid cap funds may underperform going forward. So just look at this chart. This chart shows how the various categories of funds have performed from 2003 to 2007. Large cap fund, these are the category average returns. So that on an average, large cap category funds delivered 528% return on those 4 years from 2003 to 2007, while mid cap and small cap funds deliver 900% return. So they clearly outperform. But following that, when the market fell in 2008, 2009 due to the subprime crisis, small cap funds, mid cap funds fell almost 68-70%, while large cap funds fell 50%. Going forward, when 2009 to 2010, when markets large cap was up 100%, mid cap, small cap were up 170% on an average. Again, the cycle turned, market fell, from October 2010 to December 2011, large caps delivered minus 23% return, mid cap, small cap minus 35. Sorry. Again, when the markets turned up 2012 to 2017, because it's a cycle, they were bound to go up. Large caps 128%, mid cap, small cap 241%. Coming back forward in the last post-COVID period, from April 2020 to October 2021, almost around 18-month period, the recent 18-month period, the large caps category in general delivered around 132% return, while the mid cap, small cap funds in general delivered around 190 to 200% return. And if we see the last 6 months, the small cap funds and the mid cap funds are underperforming. They are down 20% as compared to 15% on the large cap funds category. So if this down cycle is to continue, market has to fall further, market has to go down further, we don't know. If it has to fall, mid caps and small cap funds may underperform. So again, the idea is to give you a perspective that market performs in cycle and even the funds perform in cycle. So you need to be aware of while investing in mid cap fund now. Don't just get carried away by a 10% fall or a 15% fall in the mid cap indices or a mid cap index or a small cap index, because you need to be aware also the extent of outperformance in the previous cycle, which is like April 2020 to October 2021, where it has done almost 200% return. So any fund which has done 200% return is bound to bound to be down by 20%, 30%, 40%. So there's nothing unusual about it. And it's also not a very jumping kind of a scenario where it is just 20% down and I just go all hog investing into small cap fund. No, you look at the previous cycle, it has done 200%, it has delivered 200% return. So you need to be aware of the extent of underperformance, outperformance, and the time horizon of the previous cycles on which they have performed, and not just the recent 20% fall, recent 5% fall. So the recency bias is not important. Looking at the market across market cycle is important. Now coming to the very basic thing about now. Okay, now we have understood the basic gyan about the understanding. What should be the allocation strategy now in the current market? Market is down 15%. Now what investors should do? So I think what investors should do. First of all, decide. Investors should decide themselves what type of investors they are. Do you get scared? Ask yourself. Ask yourself. Do you get scared when the markets are down 20%, 30%, or you feel it's an opportunity to invest at lower levels? Ask yourself, were you a buyer in equity market during the COVID-19 induced market fall in in the month of March, April, May 2020? Or you were not investing during that time, during the COVID period, or you were more shying, or you were more concerned about market falling further. The many people were believed that the world was coming to an end. Were you in that camp where you were not investing, or were you happy that market is down 45%, market is down 40%? I should be at least start investing. I should put some lump sum amount. I should look out for opportunities to invest. Or were you shying away or staying away from the market? So you need to ask yourself, because investor behavior is more important in creating wealth than the market itself. Every market guru has told us that don't need to be an intelligent investor. You just need to be a disciplined investor. You have to behave rationally. So in a last market cycle, were you a buyer or were you a seller? Ask yourself. Next question you should ask yourself is, will you be okay if the next 1 year return is going to be minus 10%? Will you be okay if the next 2 year return is going to be 0%? If not, invest in balance advantage kind of funds, invest in debt funds, because they will give you stable 6, 7, 8% return. Balance advantage fund, because of the nature they invest, they can give you more than debt funds. So those so we have equity and debt balanced one-click portfolio, which is ideal suited for investors who are generally jittery, generally sometimes get swayed away by the market fall. Maybe that kind of scenario is today. Market is down 15%. So today, if you feel like market may fall further, invest in our our equity and debt balanced one-click portfolio, or equity and debt one-click basket. That is ideal for you. But if your answer is yes, that you do not get swayed away by the 20%, 30% fall, even today you are feeling like it's a time to invest. It's a time to start searching for opportunity. It's a time to start a SIP. While market may fall further, but I will buy more even if the market falls further. If you are that kind of an investor, start investing in our blue chip wealth creator one-click portfolio. Start investing in our best performing funds one-click portfolio. If you are an aggressive investor, start SIP in our mid cap for all seasons one-click portfolio, or even emerging small cap portfolio, very, very slowly. So mid cap, small cap investors need to invest very slowly, while large cap investors may put, in fact, not may, should put some lump sum amount in today, even today, because market is down 10%. We don't know whether market will rebound in the next 1 week, and market generally doesn't give time. Believe me, whatever experience I have, little experience I have, and whatever little I have understood from market experts, market does not wait for your next date of SIP installment. Market is not going to wait that, okay, Mr. X or Mr. Sachin has put an SIP on 1st of every month, and I should remain low till the 1st of next month. Market is not going to wait for it. Market is down today 15%. You need to invest today. You cannot wait for 15 days, 20 days, 1 month, 6 months, 6 months, 1 year down the line. Having said that, now invest something 10%, 15%, 20%. What about if market falls further? If market falls by another 5%, 10%, 15%, be prepared for investing more. So that's why we are saying put 10%, 20%, 30%. If market falls, put 10%, put 5%. If another Nifty falls by another 500 points, another put some lump sum amount. Decide yourself. But I think the easiest thing which investor can do is, invest at least their next 3 months SIP today. So even an SIP investor can do a lump sum, So I think that's what investor can do. And if you're obviously if you're an aggressive investor, you can look for mid cap fund, you can look for small cap funds as well. So it's up to you. But the whole objective is put something in today's market environment. Don't wait for the time to tell you, or don't wait for God to come and then tell you, invest now. Market will doesn't wait for opportunities. Be prepared for the market fall, but don't get a bit afraid of market fall. What we are saying is, I am prepared for further 10% fall, further 5% fall, but I am starting today and I am prepared for further fall. I think that's the very, very basic thing which investors should do and revisit. Do not get swayed away by the market, the way the markets are behaving right now. So I think that's what I have to share, very specific things on the markets. I think Neha, over to you. Maybe we can check about any of the questions if we are having. Neha, over to you.
Thank you for your input, sir. Now let's look into a few queries that our viewers have.
Okay, maybe we will wait for a minute or two for people to put queries. We are already getting questions, so maybe just let's wait maybe for the questions to get queued. Okay, so I've got a few questions, in fact, a lot. So let me start taking few questions. The few of the questions, like say, what I can say, I can just read it. So Farhan Ali is asking, what's the view on small cap and mid cap stocks, or maybe funds, if I can just extrapolate it for the next 6 to 12 months? Mr. Ali, I mean, there's absolutely no one can say how the small cap fund or the small cap stock will do over the next 6 months. That nobody knows. I know if someone is telling you that market is going to be down 6%, 10% in the next 6 months, he is telling lie. Nobody can say that. But what we can say is that in general, the mid cap and the small cap funds, after having rallied 200%, or in fact on an individual basis, many of the individual stocks have done phenomenally well. They are up 2x, 3x, 4x, and they are witnessing a correction of 20%, 30%, 40%. So my advice would be, from an individual stock perspective, be very, very careful while investing in small cap funds, especially in the small cap stocks. Follow what the future outlook looks like. Do not invest just because a particular stock is down 20%. Also look at how it has outperformed, how much return it has delivered in the last 2 years. So just because a stock is down 20% cannot be a reason to invest. Market is always forward looking. Market does not repeat in a same behavior. So the same stock which was a flavor of the market season may not be the flavor of the season going forward. So be very careful while investing in mid cap, small cap stock which are down 20-30% after having rallied 200%, 300%. Similarly, a few of the questions which I am getting is, okay, are we, another question, interesting question, I think, are we entering into a bear market given how the global markets are performing? So again, I think that's what the very, very important question which is coming to the investor's mind: are we in for a 2-year negative market cycle? Are we in for a 3-year negative market cycle? Are we in for a minus 20% return 1 year forward? Are we in for a minus 10% return? I would want to answer in a way, let's assume market is going to be minus 20% in 2 years. Let it be a bear cycle. What will happen? What I am telling you is I am investing right now, and will keep on investing at every lower levels from now on. So what I am doing, have started an SIP, I have topped up my SIP, I have started an additional SIP, and I am investing in the next 2 years. So in fact, as an investor, I am more than happy if markets continue to deliver negative returns, continue to trend downwards, continue to remain range bound, and enter into a bear market, because I am investing in during the bear market. You would always want to invest in a bear market and take out the money in a bull market. So of markets, after having corrected, if the outlook is on the market is negative, it becomes even more important for an investor to invest, because bear market is where when you should invest and not take out the money. So the investor should keep that focus in mind. Okay, and we are getting a lot of questions in terms of view sector specific funds, or view as which are the SIP funds which are best, or so from a sectors fund, there are a lot of funds which are saying, what about the IT fund, what about the FMCG fund, what about the banking funds? Please understand. Say for example, IT funds. IT funds have had a phenomenal run in last 3 years, last 2 years. Just because IT funds are down 20%, 15%, does not automatically makes them attractive. While they might be offering attractiveness, might be offering opportunities, we also look at the valuations. A lot of IT stocks had seen a re-rating in the multiples. So many stocks which were trading at a multiple of 15 times, 18 times are now trading at 28 times, 30 times. And if they are seen a correction of 20%, 15%, automatically does not make them a buy. Or if a particular stock is down 50%, does not make it an attractive buy. They are up 3x, 4x. Many of the mid-cap IT stocks, many of the mid-cap funds are up 200%, 300%. So just because a particular sector fund, after having delivered 300%, is down 20%, does not make it a good sector fund. In fact, in this kind of a market environment, where already the sector rotation has happened, it is better to stay away from the sector funds. Because in the last 1 year, what has happened is even the sectors which were earlier underperforming has started outperforming. Be it the PSU funds, be it the IT funds, be it the banking funds. So a lot of sector rotation has already happened, and a lot of sectors which were underperforming, even auto ancillaries, for example, had already outperformed. So this may not be a right time to invest in sector funds. Invest in diversified funds. Again, few of the questions which are coming is, if we believe that market may fall, is it not a right time to book profit today or not invest, and then maybe invest at lower levels, 10% down? Why invest now when I am expecting markets to fall by another 5%, 10%? Again, very interesting in terms of timing the market. If you know that market is going to fall 5%, another 5%, another 10%, very well said, don't invest. In fact, redeem all your money, wait for the 10% correction and invest. The point being, even the market gurus and even we as an analyst do not know whether market will fall another 10% or 5%. So since we don't know, we are advising, or we personally are started in investing in the market from current levels. If market falls, well and good. Doesn't fall, well and good. Market recovers, very well and good. We are in for a regular investments. So it doesn't matter whether market is going to fall further or whether I want to time it in a very concrete manner. So I think we are getting a lot of question in terms of which funds to do well, which funds. I think in terms of funds, I think a lot of in general, whatever funds are there, if an investor wants to invest in an individual funds, whatever specific funds are mentioned in our one-click basket, I think individual investor can choose based upon their individual requirement. They can pick and choose an individual fund. For instance, in our blue chip wealth creator basket, we have 4 funds. If an investor wants to invest only in one fund or 2 funds, they can select out of those our blue chip wealth creator basket any particular one fund or two fund. They can invest in those funds. Otherwise, we would recommend to invest in a whole basket as a whole, because we have selected that basket keeping in mind diversification, and not diversification not only in terms of different AMCs, also in terms of investment style, because we all know how a particular AMC funds were doing well in last 3 years, and now what they are doing in last 1.5 years. We know how a particular AMC was underperforming since just prior to 1 year, and how their funds have now are the top performing funds in last 1 year. So we all know it, right? So our objective of creating a basket is investing in fund managers who are diversified in style. And we all know that even fund managers perform in cycles just like markets. So our endeavor in our one click basket is to deliver category above category average returns. And above category average return, mind you, is a very great achievement, because in general we have seen investors investing in best funds ending up getting below category average returns. So our endeavor, our objective, sole objective of one click basket is deliver above category average returns. So I would strongly suggest follow those basket approach. So I think we are getting a lot of questions, but I think Neha, I can hand over to you. Maybe if time permits, you can ask questions. Otherwise, over to you.
Thank you, Mr. Sachin, for your time and on sharing such handy and useful tips on investments. That was great talking to you. Now that we know what the expert has to say, we hope that you make the best use of it. To know more, please visit our ICICIdirect platform or simply call your RM or visit our nearby branch. Last but not the least, thank you, viewers, for your valuable time. Stay safe and keep investing.
Thank you.